Welcome back, everyone. I'm Rob Lofaris. As we move into the final quarter of 2025 and look ahead for the new year, we have to talk about one thing that will always decide the national mood: the economy. And right now, the stock market is priced for perfection, but underneath the surface, the structural risks are stacking up. And we're looking at a system due for a possible serious correction and the pain that will be felt far outside of the auto industry. Let's look at the market itself. Let's look at the Standard & Poor's 500. Its valuation measured by the forward price to earnings is sitting near 23 times earnings. The broader PE ratio is up near 28 times, which is a level we haven't consistently seen outside of the 1999 dot-com bubble and the 2020 post-pandemic frenzy. And this appears to be a very overheated market trading on one thing: a narrative. And that narrative is AI, robots, and autonomous tech. Companies are spending hundreds of billions of dollars on this infrastructure. But where's the revenue, the free cash flow? It's not there yet. We are paying the highest premium prices in a generation for earnings that may not materialize for years. This creates a massive valuation gap, and history proves this gap is a leading indicator for a sharp correction. Now let's talk about the stock that has becoming the entire market's high wire act: Tesla. The price of that stock is not based on its core business, selling electric vehicles, which is facing stiff competition, falling margins, and falling sales. No, its valuation is based almost entirely on the promise of RoboTaxis and Optimus robots. Tesla is priced as a multi-trillion-dollar software company, not an automaker. But here's the cold reality: RoboTaxi revenue today is zero. The company is sacrificing current profits to fund a very speculative future. If that stock, due to a disappointing delivery numbers or delay in the AI roadmap, starts a significant decline, the shock will ripple. Why? Because Tesla is the flagship of a speculative nature. A 20% drop in the most hyped stock can trigger a cascading effect of de-risking across every overvalued tech and AI name on the board. And Tesla is the domino that can start the fall. And finally, let's bring in some external pressures. We have a crypto market which has been the primary beneficiary of the speculative capital. Its total market cap has been fueled by the same risk-on fever that drives AI stocks. And when the stock market corrects, when the high PE tech names get liquidated, that capital will look for the fastest exit. And crypto will be the first asset class to crash hard, signaling that the global liquidity trap has sprung. And all this collides with the trade chaos. New and expanding tariffs are taking effect, and the consequence is clear. They act as a tax on consumers and businesses. They slow GDP growth, forecasted to slow at a rate that is barely half of the post-war average by 2026. And they drive inflation by increasing the cost of imported goods. So this is the winter economic forecast: an overvalued stock market built on a narrative, a single stock poised for a major decline, a speculative crypto asset ready to crash, and new tariffs squeezing the consumer. The facts are simple. The easy money is gone. We are entering a period where risk management is far more critical than chasing returns. We are looking at necessary market corrections to realign prices with real earnings and a return to quality cash flow. But hey, I'm just Rob Lofaris, a car salesman at heart. What do I know anyway? Thanks for joining us.